today's fast-paced world, everyone wants to make their money work harder. We all dream of earning while we sleep, and that's where passive income comes in. Passive income is like planting a money tree that bears fruit with minimal effort. One promising avenue is peer-to-peer, or P2P lending. Instead of letting extra cash sit in a savings account, you can lend it directly to individuals or businesses. P2P lending connects borrowers and lenders directly, cutting out traditional financial institutions. But like any investment, P2P lending comes with its own set of risks and rewards. Remember, the key to successful investing is understanding where your money is going and how it's working for you. So, how does P2P lending actually work? It's simpler than you might think. Instead of approaching a bank, you turn to a P2P lending platform. You create a loan request, specifying the amount and purpose. Investors browse these listings and choose which ones to fund. Once fully funded, the borrower receives the money and begins making payments. Payments are distributed among the investors proportionate to their investment. This direct connection eliminates many overhead costs, allowing for competitive interest rates and higher returns. P2P lending presents a compelling opportunity for individuals seeking to generate passive income and grow their wealth. One of the most significant advantages is the potential for higher returns compared to traditional savings accounts or fixed deposits. Since P2P lending bypasses banks, investors can often earn interest rates that are significantly higher. This is because borrowers are often willing to pay a premium for the convenience and accessibility of P2P loans, while investors benefit from these higher interest payments. Moreover, P2P lending offers diversification benefits. Instead of putting all your eggs in one basket, you can spread your investment across multiple loans, minimizing the impact of a single default. By diversifying your portfolio, you create a more resilient investment strategy, mitigating the risks associated with lending to individual borrowers. Furthermore, P2P lending platforms provide a user-friendly experience, allowing you to easily browse loan listings, assess risk profiles, and manage your investments online. This accessibility and transparency empower investors to make informed decisions and track their investments with ease. While P2P lending offers enticing opportunities, it's crucial to approach it with a balanced perspective, acknowledging the inherent risks involved. Like any investment, P2P lending carries the risk of default. Borrowers may face unforeseen circumstances that prevent them from repaying their loans as agreed. Therefore, it's essential to carefully assess the creditworthiness of borrowers before investing. P2P platforms typically provide risk assessments and credit scores for each borrower, helping you make informed decisions. Another risk to consider is liquidity. Unlike traditional investments that can be easily bought or sold, P2P loans are typically held until maturity. While some platforms offer secondary markets where investors can sell their loans to other investors, this may not always be possible, especially during economic downturns. If you need access to your funds quickly, P2P lending might not be the most liquid investment option. Section 5. Mitigating risk, safeguarding your investments. While risks are inherent in any investment, there are steps you can take to minimize your exposure and safeguard your hard-earned money in the world of P2P lending. One crucial strategy is diversification. Don't put all your eggs in one basket. Instead, spread your investment across multiple loans. This way, even if one borrower defaults, the impact on your overall portfolio will be minimized. Aim to diversify across different loan grades, loan purposes, and borrower demographics to create a well-rounded portfolio. Thoroughly research the P2P lending platform you're considering. Look for platforms with a proven track record, robust risk assessment models, and transparent fee structures. Reputable platforms will provide detailed information about their operations, historical performance, and investor protections. Consider starting with a small investment amount as you gain experience and confidence in the P2P lending process. As you become more comfortable with the platform and understand the risks involved, you can gradually increase your investment allocation. Section 6. Diving in, your step-by-step guide to peer-to-peer lending. Ready to embark on your P2P lending journey? Here's a step-by-step guide to get you started. First, research and select a P2P lending platform that aligns with your goals. Look for platforms with a solid track record and transparent fees. Next, sign up and verify your identity. Transfer funds to your P2P lending account. Explore loan listings and review borrower profiles. Choose loans based on your criteria and diversify. Finally, track the performance of your investments. Monitor repayment schedules and interest earned. Remember, P2P lending is a long-term strategy. Section 7. The power of diversification. Spreading your investments wisely. Diversification is the cornerstone of any sound investment strategy, and P2P lending is no exception. Spreading your investment across multiple loans is crucial for mitigating risk and maximizing your chances of success. Don't put all your eggs in one basket by investing in a single loan or borrower, no matter how promising they may seem. Instead, aim to build a diversified portfolio that includes loans with varying risk profiles, loan terms, and borrower demographics. By diversifying your investments, you reduce the impact of a single loan default on your overall portfolio. If one borrower fails to repay their loan, the losses will be offset by the returns from other successful loans. Consider diversifying across different loan grades. While higher grade loans offer lower interest rates but are considered less risky, lower grade loans come with higher potential returns but also carry a greater risk of default. By investing in a mix of loan grades, you can strike a balance between risk and reward. Section 8. The bottom line, is peer-to-peer lending right for you? Peer-to-peer lending can be a valuable tool for investors seeking to generate passive income and achieve their financial goals. By connecting borrowers and lenders directly, P2P lending offers the potential for higher returns compared to traditional savings accounts or fixed deposits. However, it's essential to approach P2P lending with a realistic understanding of the risks involved. Default risk, liquidity limitations, and platform fees are factors that investors need to carefully consider. Before diving into P2P lending, assess your risk tolerance, investment goals, and time horizon. Thoroughly research different platforms, understand their fee structures, and carefully evaluate borrower profiles before making any investment decisions. Remember, diversification is key to mitigating risk and maximizing your chances of success in P2P lending. By spreading your investments across multiple loans with varying risk profiles, you can create a more resilient portfolio that can weather market fluctuations.